Um, I think I'm sharing the right screen.
Yes, you are.
So, you know, it's about what your financial advisor is not telling you if you have a financial advisor. It's not something that we do with our clients, but it is something that most financial advisors are now doing. It's because of the revenues and the squeeze on revenues. So what's going on is that most clients, most firms are classifying the clients. If you have a financial advisor, you've been put in a category based on how much money you have with them. Most firms are using an A plus, an A, B, and a C rating system. We don't do that. And I'll tell you more about that later. But they're using an A, B, and C rating. The difference between having a small amount and a large amount is being rated differently. So the rating system is real. And for a firm the size of Adams Financial Concepts, I'm taking this from an actual firm, from a firm that I know their system, I know what they do. I talk to them every once in a while. We share information. Their system is set up so that for clients that have 4 million or more in assets, they're rated A plus. For clients that have 2 million to 4 million, they're rated A clients. The B clients are a special category because they don't meet the $2 million threshold. They meet the $500,000 or more threshold, but they don't meet 2 million. But they have enough money from outside sources, whether it be from an inheritance, whether it be from their job, whether it be from selling a house or doing real estate, from some other investments. They have the ability to get to be an A or A plus, preferably an A plus client. C clients have a minimum of 500,000 and they're expected to stay at that level below the $2 million mark. That's how it's set up. So what does it mean for people that are rated that way? It depends upon the service you get. A plus clients get at least 3 in-person quarterly meetings. Their tax documents are hand delivered to their CPAs. They get invitations to special client events. They're wined and dined. A and some B clients get 1 or 2 in-person meetings and 1 or 2 virtual meetings. And that happens annually. Their tax documents are mailed to the CPA without them making the request. It's just an automatic process that happens. Reports are prepared, financial plans are prepared. A plus clients get their financial plans updated every 3 months. A and B clients get their plans updated usually once every 6 months. And some are invited to the client appreciation times, especially when there are not enough A plus clients to fill out the entire event. C clients never get invited to those events. They may get 1 in-person event, but more often they get a virtual meeting rather than in-person meeting. Some do. More likely they get a virtual meeting once a year. Their financial plans get updated at least once a year. And I say at least, but sometimes not even that often. They don't get any invitations to any events. Now, it all comes down to looking at how much revenue they generate for the firm and how much time the advisor and staff get to spend. A clients get 10 hours, B clients get around 5, C get less than 3 hours per year, all based on how much revenue you create for the firm. Now, that being said, there's a lot of conferences, and in those conferences, people are talking about what to do about growing the firm. Because if you're not growing, you're falling behind. If your revenues are growing faster than your cost and costs are rising, you're going negative. So some of the things that are happening, I went to a breakout session, for example. Touchstone Investments is a firm that's a consulting firm to financial advisors. And they did a survey of over 4,000 advisory firms. That's a big percentage of the total that exists today. And the recommendation at the conference and in their workshop was you should get rid of your C clients. Spend your time, those extra 3 hours that you spend on C clients or 2 hours, whatever you spend, should be spent on getting more A clients, or at least more B clients. A plus clients are a big plus anyway. That's where the time should be spent. So how do you get rid of your C clients? You can bring in a rookie broker or a rookie financial advisor and pass the C clients on to that person because they'll have a lot of time. Or you can pass them off onto staff. Or you can actually sell those clients to other firms. We were approached by a firm that had about 18 or 20 C clients that they were shopping around trying to get those clients sold off to someone else. That's what happens. If you're a C client at one of those firms, that's where you fit, not at Adams Financial Concepts. I want to stress that over and over again. And I'm going to tell you why later on. So the real focus of firms is on advisor growth, on growing the firm. And there's a real logical reason for that to happen. Not just a logical, a real reason. Because costs are rising. In today's market, costs are rising even more than they did for the last 20 years. Costs are rising, and I've seen a study that said 60% of the firms have seen their revenues rise more slowly than their costs are rising. That's a problem. So in order to grow a firm, people are looking to grow their firm at roughly 20%. And a lot of firms are accomplishing that. This is taken from Investment News. They do an advisor benchmarking summary. They do we participate in that, as do another 800 to 1,000 firms, sending in all your data. It's a collection of your profit and loss, classifying it, classifying employees, classifying compensation, classifying your growth. But if you look at what's happening, the average financial or registered investment advisory firm is actually growing. They compared it to the Standard & Poor's. The red line is the Standard & Poor's, of course. That's the Standard & Poor's number. And this is what advisory firms are doing. The blue line is the advisory firms. They're staying up with it. So how does that happen? During 2024, the average registered investment advisory firm grew 20.6%. The firm grew that much. But what about the clients? Investment News breaks it down into the components of that growth. Where does that 20% come from? Where does it come from? Let me share that. This is the components of growth. You can see the 20.6% is here. That's the average growth of firms. But look over here, where it's coming from. Client referrals. If you give a referral of a client, that's 2.5% of that 20. Almost 10% of the growth comes from new accounts open from referrals, client referrals. There's a significant impact. Remember that I said Touchstone Investments said the effort should be on the getting rid of the C clients, shuffling them off, and focusing on A and A plus. That's the focus. They wine and dine and expect to get referrals out of that. 10% of their growth comes from client referrals. Another 0.6%, a little bit, comes from centers of influence. These are people like attorneys and CPAs who refer clients. Not a huge amount, but not insignificant. Custodians will sometimes refer clients, especially when the firms are bigger. 0.1%, not bad. People spend money on business development. Adams Financial Concepts spends money on business development. We do. And you get about 2.1% for the average firm. Not quite 10%, about 8% of the growth comes from business development. But look at this, 4.2%. Remember I talked about the B client being the type of client that could add money from outside sources and bring new money in from inheritance, from other assets they hold, like real estate or their work, bring in their money, retire, roll in their 401k. This is where a significant chunk, this is close to 20% of where the growth comes from. And of course, you do lose some. You lose clients. 2% of the money rolls out from clients moving their accounts. 3.2% rolls out because of clients taking funds out, taking income out. Clients needing the income, 3.2%. We'll skip this for a minute and come here. 5.6%, over 20%, almost 25% of the growth comes from buying and merging firms. There's a big focus. I hear from people that want to buy Adams Financial Concepts. I probably hear from somebody 3 times a month, maybe even more often. And we are, in fact, merging with another firm, a smaller firm. Some of our growth will come from that. This is a pattern. There's the number of mergers going on in the industry continues to rise all the time. And there's a very significant amount of private equity money that's flowing into registered investment advisory firms to roll up smaller firms into larger firms. And about 10%, of course, comes from hiring advisors from the brokerage houses or from other RIA firms. That's where it comes from. But I want to come back to this. 7.9% is what comes from the growth of client portfolios. The firm may be growing at 20%, but your account's only growing at 8%. Look back at the Standard & Poor's was up 22%. You're up 8%. If you're at a firm, you're up 8%. If you're at a firm, you have the right to find out what percentage your account is up. Is it up to Standard & Poor's? Is it up anywhere close to that? No. So why is it up only 7.9? I think you see, if you listen to CNBC, you see Josh Brown, who wrote a book called Backstage at Wall Street. And I took a quote from that book. Most of the brokers, and he called them brokers, financial advisors, most of the financial advisors he knows and met over the years are phenomenal world-class salespeople. But most of those salespeople don't attain the knowledge necessary to actually accomplish anything for their clients, especially when it comes to investing. Selling their expertise is actually a lot easier than actually developing it, especially as it pertains to investing. Look back at this, 7.9% when the Standard & Poor's was up 22%. That's not, in my opinion, a very great return. Winning and dining has a price tag. The more appreciation events you're invited to, the more revenues you have to create. The more time you want to spend with your financial advisor wants to spend with you, the more assets, the more revenues you have to create. And for most people, the math just doesn't work. 5% growth over 25 years turns a $500,000 account into 1.6 million. That's why advisors keep looking for those people who can add more money. That's why they look for buying other firms. That's why they look for bringing in new advisors. They need to do that to keep their revenues ramping up. They need to get referrals. They need all of that to ramp up their revenues. You know, a 10% annual growth at 500,000 becomes 5.4, and at 15%, oops, the numbers are wrong. It reaches over 16 million. Sorry, the slide is dead wrong. At 15% over 25 years, it's over 16 million. 10 times what it is at 5%. And the average financial firm is giving a 5% growth to their financial advisors. 7.9 was, the market has been very good. It was up 22%. The average account for clients up 7.9. But over the long term, it's closer to 5%. So what do we think? Let me tell you, I think every account should matter. Every single account should matter. Whether it's 100,000 or whether it's 10 million. But most firms don't do this. In fact, the industry doesn't do it either. The industry has adopted what they call the general investment portfolio standard. And that's the way when you combine all the portfolios into one, it's the way that things are reported. It's the GIPS standard. That's what firms do. It's all rolled in. It's a statistical method, and it's based on a return on investment method. I believe they have it exactly wrong. I believe that for individual accounts, they should be on an return on investment calculation, and for the total composite of accounts should be on a time-weighted value. And I'll tell you why I say that. If you have an account, if you start with $100,000 in an account and it's down 50%, so it drops from 100,000 to 50,000, and hopefully you can stay with the math. And the next year you add $1 million so that you now have $1,050,000 and the account goes up 10%. The account is now worth $1,155,000. My math is correct, and I think it's correct, right? So you put in $1,100,000, now you have $1,100,055. But if you do the math, 0.5 times 1.1 means that that account is showing a 45% loss. That is the time-weighted return. If you do an internal rate of return on that account, you'll see that it was up about 3 or 4%. No, 7% on that account. That's internal rate of return. For our clients, we use an internal rate of return. But now think about the time-weighted account for a $100,000 account and a $10 million account. The 10 million on a time-weighted is going to have 100 times the weighting of a $100,000 account. 100 times more. So what does that do for the incentive for the financial advisor, for the money manager? It means the focus is on the $10 million account. The focus is on the A+ client. Who cares about the C-rated client? That, we think it's done completely backwards. We do a composite. we publish our composite. Our composite is made up so that a $100,000 account is weighted exactly as much as a $10 million account. Neither the management of those accounts is equal. It means as much for a 15% return in a $100,000 account as it means for a 15% return in a $10 million account. Our focus is equal. That's what we do. That's Adam's Financial Concepts. So for you, if you have a financial question, a financial advisor, the question is the advisor focused on growing your wealth or maintaining what you have so that they can focus on growing the firm by reaching out to other clients? Is their focus on other clients or is it on your account? If you can really look at that and say it's not on your account, if you can look at, and you can track how well you're doing. You can look for the numbers. And if your numbers are not in the over the long term in the 14 or 15% range, you know where you're being classified. You know, if that sounds like your situation, maybe it's time to find an advisor who treats every client the same. You know, and of course, I take credit for Adam's Financial Concepts. That's what we do. If you look at this graph, this is actual client composite of our clients. Clients that were with Adam, with me before I started Adam's Financial Concepts, some as long as almost 40 years, some who have been just one full quarter. That includes people that came and went, whether they passed away, whatever happened. Some people have decided they want to move on. It includes all those accounts, every single account. And remember, I pointed out 7.9%. This is the compilation. This is the financial advisor. It was a study that was begun by Melissa Adams. It's with Investment News. These are the returns that the average financial advisor achieves. These are the returns that we achieve. We had a big dip down, no question. We have greater volatility. When the average financial advisor account was up 7.9, we were up 56. 10, we were up 17. And this is actually advisors at Schwab and BlackRock. This was what they achieved. They did a little better. That's where we are. And of course, I can't show that without putting up the disclaimers that past performance is no guarantee of future returns, that we use the Standard & Poor's with dividends reinvested as a comparable index for all firms, and that we use all of our active accounts as well as closed accounts with the same objective, and they're net of all fees and expenses, net, net, net. You can find all that on our website. We publish it. You won't find many financial advisors publishing their results. They don't want you to know. You got you're averaging 7.9 when they're averaging 20% growth, and the Standard & Poor's average is up 22%. That's us. That's where we are. And I think it makes a real difference. And let me tell you why. Let me tell you at the end, or let me tell you about Alma. Alma's client. Alma brought her 3 accounts into Adam's Financial Concepts in early 2011. They totaled about $500,000. She would have been classed, had she gone to most financial advisors, she would have been classed as a C client, would have gotten 1 virtual meeting a year, would have had to request her tax documents be sent, would get her 3 hours, get a financial plan. She was a professional. She was working 5 days a week. She's 65 years old, bringing in an income of about $50,000 a year. When she came to me, she said, I've reached retirement age. I'm think I need to take Social Security, but she says, do you think I can reduce my time that I have to work? I may have to work the rest of my life. I'm 65 years old, she said. I don't have enough money to retire. 500,000 is not enough money to retire. I looked at it and I said, you probably can take one day a week off. She was thrilled with that, taking one day a week off. So now she's working 4 days a week and generating enough income from her 500,000 and rolling on. She had purchased a condo in a neighborhood close to her daughter and a friend of her daughter's. And even with a 6% withdrawal rate, she was going to have to continue. But she was going to be able to cut back one day. So that was 2011. 2018, period of 7 years, she'd taken out an income of over 200,000, supplementing her 4 days of work and doing some traveling. The accounts had not only furnished the income, but they'd grown enough that when we sat down and talked, and we hadn't talked for years. We don't do a regular meeting every year. We do it as clients are interested in doing it. Her accounts had grown enough that she asked if she could pay off the mortgage on her condo. It was a question of I told her, financially, it doesn't make sense. You have a low interest rate on your condo, but it's not a question of financial. It's a quality of life decision. If it makes you feel better to pay off your condo, you should do that. So she did. She paid off her condo. And a year later, she wanted to talk again. And her accounts now, her 500,000, even after taking out 200,000, stood at over 1.1 million, even after taking out the money to pay off her condo, stood at 1.1 million. And she said, now, do you think I can take more time off? And I said, you not only can take more time off, you can actually retire and continue a full amount of your income. She said she really wanted to do that on a personal level. She had developed a relationship with two young daughters of her daughter's friend and was like the adopted grandmother for the two daughters. And on July 1st, 2020, she did retire. In the same spring of that year, she sent me an email saying her accountant said that she owed $50,000 in taxes. She asked me how that could be possible. She had never made $50,000 from her professional life, never made $50,000 in her entire, or $50,000 a year for her entire life. How could she now owe $50,000 in taxes? I said, I'd look at it. And I called her back and I said, yeah, sounds correct. I sold one of the stocks in the portfolio and the capital gain was significant. So significant, she owed $50,000. And since it happened in her account, I recommended paying the capital gains tax from the account because that's where it had been generated. I mentioned capital gains of that amount were probably going to be a regular thing and maybe more. And I said to her, welcome to being a millionaire. Her accounts at the end of September, she's continued to take her full retirement. She's continued to take additional money for travel. She continues to take additional money for helping her daughter and son-in-law when they lost their jobs. She's continued to take a significant amount out of the account. But at the end of this last month, the accounts were over $2 million, 2.2 million. She's withdrawn well over $1 million. When there's, that's a success story you don't often hear. That account was an account when it opened it just 14 years ago, would have put her as a C client with one in-person or one virtual meeting a year. No invitations to any events, and we don't hold very many events at Adams Financial Concept. She'd been through the pandemic. She'd been through all those things, and yet she has over $2 million now from starting with 500,000. She would be now, if she moved to another financial advisor, she'd be an A-rated client. She was a C back in 2011. And during that time, she never expected to be able to retire. She never expected to discontinue working at least 4 days a week. Now she's completely retired. She has time to do what she wants. She does travel. You know, it makes a difference. It truly a difference. You know, most financial advisors use a financial plan. They plug in all the client's assets. They look at what's going on. They put in values like the 7% or the 5%. If you look at this over the long term, this is what happens. 500,000 over a period of 15 years grew to 1.1 million. Just doubled over 15 years. For our clients, 500,000 grows to 4.9 million. Alma came to us in this time period, and she doesn't have 4 million. She has 2.2 million because she's taken over 1 million out of the accounts over the years. That's what I call true success. That's what I love. We believe that $100,000 account can grow to $1 million. We want to see that happen. We believe that a $500,000 client is not a C client, that client deserves to see their account grow. If they're not taking income to 5 million or to be 2 or 3 million at the time when they're taking money out of the account. That's what we want to do for our clients. That's where we are. That's the pat on the back. We don't classify our clients as A plus, A, B, and C. We classify our clients as everybody is unique. Everybody has a unique need, a unique strategy, and a unique goal. That's what we want to do with our clients. And I'm sorry, a lot of times this workshop and these times are focused on what's going on in the industry. But this time I just really had to talk about what's going on with financial advisors and what we do as a firm. And with that, why don't we move on? And let's see if there's any questions that you have being here.
All right, Mike, I'm back, and everybody, I'm back. It's Chris Prouty. For those of you who joined while Mike had already started, I'm here to moderate and to send any questions that come in over to Mike so he can answer them. And I've got a couple of questions queued up right now. If you do have a question, you can certainly use the webinar chat to send that question my way. Just realize that if you do that and you send it to everyone, everyone is going to be able to read your question. Otherwise, you could use the Q&A function to send that privately to me. Mike, somebody's asking about the A, B, and C ratings, and they're asking, are their returns the only indicator if they're classified that way by a financial advisor, or are there other things that would help classify that they could look at to classify them? What would be how they'd be classified?
It's all about not the returns, it's all about the revenues you create for the firm.
Mm-hmm.
The more revenues you create, the greater your classification. And revenues are generally a function of how much money you have at the firm. Yeah.
Yeah. Mike, somebody else is asking if you can explain your fee structure and what you charge for when people work with you.
Oh, yeah. We're much more expensive than most people. The firms that rate you will only charge 1 or 1.1%. We charge 2% for the first 2 million and 1.75% over that. So we are expensive. We believe that we're worth that.
Mm-hmm.
If the focus is on fees, you're probably not a good client for us. If your focus is on growth and return, you fit our clients.
And somebody's asking if you can go back to the return graph that you had showing your returns compared to average.
Sure.
They just wanted to see. They said they wanted to see it one more time so they could make sure they understood it. There we go. And they're asking, could you just explain it one more time and a little slower?
Okay. So if you look at the numbers down below, this is the graph of an investment of 500,000 invested at Adams Financial Concepts as in the composite of client growth. We have clients, every client is unique. This is approximately 140 or 150 different accounts, all grouped together. Some are conservative, some are aggressive. There's a few aggressive. There's not many aggressive accounts in this line. Most clients have moderate growth needs, growth and risk tolerances. So this is what the returns have looked like for in dollar terms over a period of these 15 years. So an account of 500, beginning at 500,000 would have grown to just under $5 million. For the average financial advisor, that account would have grown, the $500,000 account would have grown just to 1.1 million. And so you see the difference in the curves. They have far less volatility than we do. We say that's just part of being part of the return. The numbers, these are the years over which this is run. This is what the Adams Financial Concepts return has been. You can see we've had some really good years in 2019, 2020, 2024, 2025. So we're up around 15% at this point. The market is up about 15%. Be interested to see if the average financial advisor is up more than 5%. I didn't have studies, so I had information. I estimated what the returns were for financial advisors in this 2009 coming out of the Great Recession. Cerulli and Associates did a study and showed the returns in 2010 and 2011. I had to estimate again in 2012, 13, and 14. Those estimates are based on a study done by SEI, but they didn't do it year by year. They did it over the 3 years. And the returns were from the middle of 2012 to the middle of 2015. And so it's not a year by year return. I looked at those. This was a report done by Schwab and BlackRock last year. They found 11.4%. This is investment news. This is what investment news had. Down 2.4, up 5.1, 8.4, minus 4.4, up 11, up 24 in 2020. You can see we were up 40%. We were up 77, 12%, where we didn't have a great year in 2021. And 2022 was a terrible year for us. The average financial advisor was down just 11%, but we completely recovered. And this is what the Standard & Poor's is. So the Standard & Poor's doesn't show up on this. I don't know. Is that too much information?
No, that's good. And there's a follow-on question that I actually love this question because this calls back to a lot of things that we've talked about week over week. And the question is about you're picking individual stocks, unlike other guys who only do ETFs.
Yes.
So
Our focus is based on 3 principles. We're looking for stocks that have twice the upside as downside. We're looking for individual stocks, focused stocks, stocks that we think can perform very, very well over the long term, and a limited number of stocks. We're 8 to 12 stocks in a portfolio because mathematically, it shows that that's an optimum. Actually, 4 stocks is an optimum, but we choose 8 to 12 because there were studies showing, and economists have gotten Nobel Prizes showing that there's no statistical difference in owning 8 or 9 stocks and owning 300 stocks. So our focus is not on owning ETFs or mutual funds. We focus on owning individual stocks, and we stay away from the go-go stocks. We're not invested in any of the Magnificent Seven or the Mag Six or the Mag Eight or whatever they happen to be. We're focused on finding fundamentally strong stocks and sticking with it over the long term.
Mm-hmm. In one of our previous conversations, you talked about your methodology for picking a stock that IPOs and before it hits an index fund. A little bit more than we have time for today, but you do have a very specific methodology that looks at lifestyle changes, that looks at things that are going on in society, as well as looking at stocks and how they perform.
We certainly do. And if the viewers want to see that, it's on YouMoney, YouTube,
The YouTube.
About Money.
Yep.
And I think you've posted that
I,
link.
Yep. Into the chat. I put a couple of links, Mike, in the chat. First of all, I put the link to the YouTube channel, which is where we publish the rebroadcast or the replay of these talks. That will usually show up around tomorrow or on Monday. So you can go to the channel there. You can subscribe to that channel, of course, to get alerts when that thing is posted. But I also, Mike, I included your email address in the chat as well for anybody that wants to get on a call with you, have you review their portfolio. You're not there to sell. They already know if they want to work with you. But your email address is there and available. Mike, coming into the Q&A, somebody absolutely agrees on the number of stocks. And so that's great to hear. And then the question is, so do you tend to buy and hold longer in this scenario?
My average hold time is buy and hold longer term. The average is probably in the neighborhood of 5 years. It's shortened considerably over the last 30 or 40 years. There was one stock that was in the portfolio. It went into portfolios in 1993. It's went into portfolios of between $10 and $12 a share. And it split 2 for 1, then it split 3 for 1, then it split 2 for 1. So the cost basis on that stock was 87 cents to $1.02. I started trimming it back in 2018, back in this time period, to buy some others and moving the money into other stocks. I trimmed it back, didn't completely sell it out, but began to trim it back. It was probably 25% of the total portfolio of all client portfolios. It's now less than 1%, but it had grown from $1 to $100. Today, the stock is around the 80s. It was a stock that was, for at least one client I had, a very controversial stock, because who wanted to pay $5 for a cup of coffee when you could usually get a cup of coffee for 50 cents?
Mm-hmm.
And the client actually left Adams Financial Concepts, or actually that was before, because he was so adamant about that one particular stock. And he said when McDonald's came with Mac Coffee, that it would destroy Starbucks. I haven't heard from the person ever again. He took his account, but obviously Starbucks did survive McDonald's. Anyway, we've also had stocks that we bought and have lost money on. So not everything works out. And I want to make that clear. Not everything works.
Your transparency is amazing.
But in total, we have a pretty good track record.
Hey, Mike, I have a question. What is the topic that's coming up next week?
Yes. Next week, old Chinese proverb says a rising tide lifts all boats. But when the tide goes out, well, this is not part of the proverb. I believe, however, this is something that Warren Buffett used, or I read it from something from Buffett. A rising tide lifts all boats, but when the tide goes out, you get to see who's swimming naked. We could be coming up to some really rough times in the next couple of years with potentially stagflation, potentially some rough times. We've been in a period of time from 2008 until the current times when the economy is growing and the stock market is growing. We could be hitting a time in which things go the other way.
Mm-hmm.
And we just want to be in the right stocks at the right time. We don't want to see who's swimming naked in our portfolios.
Or in general.
Or
Mike, another question. Is there a minimum investment time period to have our portfolio with you?
yeah. In reality, probably 5 years is a minimum time. We're going to see volatility during that time. There were people who invested with us back at this period of time. They have been underwater for this entire period of time. They're now seeing their accounts move above. And I wouldn't be surprised to see us in the next couple of years be up here, but we could be down here. I believe it's taken them a fair amount of time to recover. If they're in for 10 years, I think they'll be considerably ahead. But
I'm going to put out a last call for questions. And while I do, I'll remind you that in the chat, I have placed two links for you. First, a link to the YouTube channel where we publish the rebroadcast of these episodes, as well as Mike's email address. You just drop him a note and you can ask him questions directly, especially individualized questions, because as Mike mentioned, these workshops are designed for a general audience, but you're unique and you have unique portfolio, unique financial needs. And one of the things that Mike specializes in is nailing down your unique situation and giving you guidance specifically for what it is that you're up to. So you can use his email address to get a hold of him. He responds to every email that he gets. And last call for questions. If you do have a question, Mike, we everybody that came stayed the whole time today. Thanks everybody for doing
thanks
that.
everybody.
Yeah.
Great to see you.
It's
And next week, a rising tide lifts all boats, but
keep an
that goes out.
keep an
You
eye
get
on
to
your
see who's
email.
swimming naked. Thanks for being here. Hopefully you learned a lot today. And if you do have a financial advisor, you learned about where you sit in their categories. And the numbers are increasing, by the way. C client, there are now a number of people that are raising the C level from 500,000 to 1 million, raising the A plus level, raising the A level. So it's all about how much money you make for them, not how much they make for you. Thanks for being here, and come join me next week. Take care now.
See you then.